Hello, my friends. Today is September 17th, and this is my September FOMC debrief. So I just finished watching Jay Powell's presser, and I thought it was a pretty good press conference and a pretty interesting meeting, so we have a bunch of stuff to talk about. However, as usual, let's first level set. Now, between this meeting and the last meeting, we had a lot of stuff happen. On the labor market front, as we've been discussing, the labor market has been pretty disappointing. A whole bunch of jobs that we thought we had were revised away. And the most recent jobs report was pretty disappointing, where jobs, about 20-some thousand created, lower than expectations. However, the unemployment rate remains pretty low at around 4.3%. Now, looking on the inflation side, things really haven't been improving either. Taking a step back, it really looks like inflation is stuck at about 3%. And looking ahead, there doesn't seem to be a path for inflation to come down. Actually, there's a good argument that inflation could actually tick up a little bit on account of tariffs. So if you're the Fed looking for 2% inflation and full employment, you're kind of not doing very well on either mandate. So you're in a pretty tough position. Now, we all knew since Chair Powell telegraphed that at Jackson Hole that he would be cutting rates today, so the market had fully priced in a 25 basis point cut. Now, heading into this meeting, there were a few questions. Well, first off, on the political front, we have the newly sworn in distinguished FinTwit alum Steve Myron joining as Governor Myron as his first meeting. We also have Governor Cook, who was fired by the president and reinstated by the Court of Appeals. So you had some interesting dynamics there. Wasn't sure if there would be a lot of dissents. Maybe some people wanted 50 basis points. Maybe some people didn't want to cut at all. So that was a question mark. There's always, of course, on the margins, some people hoping for a 50 basis point cut. And of course, for me, the biggest question was how the Fed would project its dot plots in 2026 and 2027. Now, heading into this meeting, like we discussed, market fully priced in 25 basis point cut, and also, let's say 25 for each of the meetings throughout the end of this year. However, the market also priced in a whole bunch of cuts for 2026, going as low as 2.9% in December 2026. That is actually much lower than the June dot plot. And so there's kind of a big disconnect where the market was thinking and where the Fed had guided towards in June. And as I wrote about on Monday, my perception was that the market would be forced to move to the bit hawkishly to the Fed a little bit after today. So those were the questions heading into the meeting today. Now, at the meeting, again, immediately we got the 25 basis point cut as expected, no 50 basis point cut. That was always very, very unlikely. And we did get a dissent. And that dissent, of course, comes from Governor Myron, who wanted 50 basis points. No other dissent, so it looks like the FOMC as a whole is still pretty cohesive on that front. Now, more interesting thing is looking at the dot plot. Now, looking at the dot plot, the dot plot didn't change that much between this meeting and the last meeting. It looks like the Fed basically just penciled in an extra cut. So again, the dot plot is much more hawkish than was priced into the market. And on the economic forecast front, it looks like the Fed marked down their unemployment rate a little bit, so a little bit better growth, and marked up their inflation a little bit, so inflation a little bit worse. So that's kind of how they're looking at it. One, of course, very interesting thing is that if you break out the dot plot as to where the committee members stand with respect to rates at the end of 2025, you'll notice a whole bunch of them are clustered around, say 4% or something like that. And there's this one dot that is very, very low that is actually looking for a 50 basis point cut in each of the last 3 meetings this year. And so I think we can all guess who that is. Okay, so going to the Powell press conference, again, I think there are 2 things that really stood out to me. Well, actually, I'll say 3 things. Well, first off, what's his rationale for cutting rates today? So what does he say? So Powell basically says that the labor market is not as strong as he thought it was. Over the past few meetings, Powell had repeatedly asserted that the labor market is doing really well. Looking at the unemployment rate. And so his focus was mostly on inflation. Now, he mentioned that looking at the revised data, the labor market really doesn't look as good as he thought. And so the risks are a bit more two-sided now. He can't really just all think that much on inflation. And he also suggested that, inflation is not as worrisome as he used to think. So I take that to mean that inflation is probably going to be stuck at around 3%. It's probably not going to get worse to 4 or 5, 6%. Now, during the pandemic, it was super high. That was totally unacceptable. But my sense is that 3% inflation is actually okay to him. The second thing that I thought was super interesting is how he perceived the upcoming job numbers. So, as we mentioned, last month we only created 27,000 jobs. And actually, in June, after revisions, we actually had a negative jobs number. So, his perspective was that because a lot of the weakness, the perceived weakness in the labor market, it really is just due to immigration, supply and demand dynamics over there. So he thought that a break-even job growth because of our reduced immigration is between 0 to 50,000. So any number, according to this perspective, any number of we get from the NFP report going forward, if it's between 0 and 50,000, it's probably okay because we should expect low job growth because we have lower population growth. Now, Berger, who is a smart person who focuses on employment, also suggested that they kind of just look at the unemployment rate to kind of derive what the break-even number is. So that's kind of the headline number is not super important, but really what matters is the unemployment rate. And I think that makes sense as well. In any case, based on where the unemployment rate is today and based on the job growth numbers we've seen over the past few months, it seems that it's correct that the economy, because of low population growth, these low job numbers actually don't seem to be super concerning. Though, of course, if you look at other things like wages and so forth, it does seem the labor market continues to weaken. All right, so that means that actually a pretty hawkish perspective, really. It means that the Fed is not going to be super worried about the lower job growth numbers going forward. And another thing that I thought was pretty interesting he mentioned was his perspective on tariffs. Now, we've been talking about tariffs for months. And initially, what I was telling you guys is that just looking at the past, what happened in 2017, 2018, is that the distributors, like the middlemen, they ate the tariffs as profit through lower profits, and they really weren't passed through the consumers. And that's really what happened based on studies looking at hundreds of thousands of prices in 2018 and 2019. And Powell basically are saying right now that, yeah, that's kind of what's happening right now. All these distributors, they're eating the cost, eating the tariffs. They plan on passing this on to consumers, but they're having trouble too. So he's saying that pass-through could be very slow and very low. So at the moment, there really just doesn't seem to have been a very big impact from tariffs on inflation. So that could come going forward, but if the economy weakens and the FOMC is projecting below trend growth, and I also am quite negative on the economy. So that won't be passed through, and it will continue to be eaten by the distributors. So it looks like everyone who's afraid of a massive inflation from tariffs does not have to be afraid. I think that's all right now. So going forward, I think we'll just just looking more closely on the employment market, and that's going to be what happens. Again, the market is fully pricing in another rate cut at the next meeting and another rate cut in December. And beyond that, though, I think we'll just have to see who the composition of the FOMC is because personnel changes, either what happens with Governor Cook or, who the next Fed chair is, and of course, whether or not Chair Powell will leave after his term as Fed chair is over. Those are the questions that will shape the rates market for next year. All right. That's all I prepared. Talk to you guys on Saturday.